whenever the RSI moves above the 70 or 80 level in the market. We typically view the price as overbought and start selling. When the RSI drops below 20, most retail traders consider it an oversold condition and tend to buy here without much thought. However, often the price continues to climb quickly even in the overbought zone, and sometimes it drops sharply despite being in the oversold zone. This shows that the RSI cannot be used in this straightforward way. If you're also using the RSI like this, then you're mistaken. That's why, in today's video, we'll dive deep into how to use the RSI indicator properly. But before we continue, if you find this content useful, smash that like button, and if you're new here, make sure to subscribe and turn on notifications so you never miss our latest uploads. I'll see you right after the intro and disclaimer. The RSI strength indicator shows us how much strength the price holds at any point on the market chart, as well as the momentum the price carries and the speed it maintains. This indicator reflects the direction in which the price is moving. With its help, you can easily assess the strength of buyers and sellers and plan your trades accordingly. Reversals tend to happen near the RSI levels, which makes it easier to identify them. Therefore, in today's video, we will explain how to use the RSI as a spotting tool. To spot RSI, we first need to understand the RSI divergence. Whenever the price on the market chart keeps moving down, forming lower lows, and simultaneously higher lows appear on the RSI line, it indicates a mismatch between our price action and the RSI. Here, the price keeps dropping, which shows sellers dominating the market, representing a bearish signal. On the other hand, if the RSI is trending upwards while the price is falling, it indicates that the market's relative strength is increasing rather than decreasing, which is a bullish signal. This mismatch is known as divergence. We can use this divergence to identify potential price reversals on any chart. There are primarily two types of divergence in any market condition. Number one is bullish divergence, and number two is bearish divergence. Let's first understand bullish divergence. This is 5-minute time frame chart, where bearish sentiment is causing prices to steadily fall, forming lower lows. From this chart, anyone can see the market is in a bearish trend, but it is difficult to determine the strength of sellers at specific levels. However, applying the RSI to the chart makes this clear. We haven't changed the RSI settings for this example. By default, the RSI upper line is set at 70, the lower line at 30, and the middle line at 50. Which many call the zero line. Now, you all know how to apply the RSI to a chart, so we won't go over that. On this chart, if we connect all the price lows with a line, we see it trending downward. However, the RSI line shows a steady upward trend at the same time. This indicates a divergence. Here, the price is falling while the RSI line moves up, signaling a bullish divergence. Initially, when the price dropped, the RSI fell below around 30, but later, as seller strength decreased while the price kept falling, the RSI slowly moved upward. This indicates the market's price momentum and speed are declining, suggesting a high probability of reversal. But now, you might be wondering where to enter the trade in such a situation. Here, two bullish candles have formed, and a bullish divergence is visible. So can we enter a long trade? In such cases, if the price is dropping and a bullish divergence has appeared, you should wait until the price breaks its last higher low upwards before entering. For example, here the price has formed its last swing high, and the market hasn't broken it yet. So we won't enter a long trade now. Later, when the price breaks this high with a strong bullish candle, we can enter a long trade with an appropriate stop loss. This could allow the price to reach our profit target quickly. When entering a trade during a bullish divergence, always remember, if the RSI is below the 50 line and a divergence is forming, enter on the bullish side to achieve good results. If this condition isn't met, avoid entering the trade. Keep this in mind at all costs. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Let's now understand bearish divergence. This is a 5-minute time frame chart, where the price is consistently moving upward, forming higher highs. This indicates that the market is showing strong bullish sentiment on the chart. Seeing this, many retail traders jump into long trades during the breakout, but shortly after, the market drops, trapping them in a false breakout. To avoid such fake breakouts, the RSI divergence can be very useful. Once we apply the indicator to this chart, we can see that the price is climbing, but the RSI is also moving upward with weaker momentum, signaling a bearish setup. Here, the price is still attempting to break out after 11 to 1, but since very few buyers are participating in this move, the buying pressure has declined, which can easily be seen through the RSI line. Therefore, it's better to avoid entering long trades during such breakouts. Instead, by recognizing the bearish divergence, you should focus on finding a short trade opportunity on the chart. For instance, in this chart, when the price breaks below its previous lower swing low with a strong bearish candle, you can enter a short trade with a proper stop loss and aim for a solid profit target. However, always keep in mind that you should never enter a short trade until the RSI line rises above 50 and a bearish divergence has been confirmed. Only under these conditions can you achieve a good profit outcome. Instead of trying to trade using hundreds of different strategies, it's much better to master just one or two and use them consistently. This approach improves your win ratio over time and helps you trade with a calm and confident mindset. In this video, you've learned 2 key strategies. A few things to remember. Number 1, an RSI bullish divergence forms only when a bullish setup appears, and that's when you should plan your long trade entry. Number 2, a bearish divergence should only be traded when the RSI line is above 50. Confirming the bearish setup, and you should plan for short entries only then. Also, always enter your trade only after the breakout of the previous swing high or low. This helps you target larger profits with smaller stop losses and reduces the chances of stop losses being hit frequently. That's it, traders. Thanks for watching this video. Most people watch and move on, but the ones who act, the ones who apply, are the ones who get ahead. If this video pushed your mindset or gave you direction, hit the like button right now. And if you're new here, subscribe and turn on the notification bell, because the next video might be the one that changes how you think, trade, or decide. Stay sharp, stay consistent, and don't slow down for anyone. I'll catch you in the next video.